know it's a broad and a difficult question for you to answer, but how do you ignore the noise?
I actually think it's a good question and quite a fundamental question as well, isn't it? Because if you look at all the different inputs to that noise, then you'd be running around like a headless chicken, wouldn't you? So you'd be changing your investment style every 5 seconds. I think it just goes back to fundamentals. Part of our job, I think, part psychologist and part analyst, really, isn't it? And the psychologist bit is about keeping you true to your investment style.
Hello and welcome to Investing for the Long Term with Judith Mackenzie and Rosemary Banyard. Judith is partner and head of Downing Fund Managers, and Rosemary is an award-winning fund manager who manages the VT Downing Unique Opportunities Fund. This is the fourth episode of what used to be a 6-part episode, but has now grown to a 7-part series where each episode builds on the next and becomes part of a mini-series of an investor's journey. During this episode, Judith and Rosemary share what are the traits or personality characteristics of a person who can hold an investment for the long term. What was it like investing through the 90s tech bubble or the financial crisis of '08? And what was it like during COVID-19 when it seemed that the whole world had shut down? This was another great insight into how two seasoned fund managers think and how they view investing for the long term. If you enjoy listening to this episode, please let us know by leaving a comment, subscribing and sharing with your networks. That way we can keep more great content coming your way. And just before we get started, please remember that all opinions and information are for educational purposes and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. Always do your own research and seek financial advice from a regulated financial advisor in your country before making any financial decisions. With that being said, let's get started. Hello, Rosemary. Hello, Judith.
Hi there, Lee.
Hi, Lee.
Good to see you again. Looking forward to this one. Psychology of investing through recessions. And one of the things I was curious about was, in your experience over the years, over the decades, you've met many professional investors, many private investors. I was wondering, what are the traits or what were the characteristics that really stood out to you as someone who can hold investments for the long term?
For me, I think there's probably 3 points. And one is that you've got to have a real understanding of your own investment style. And we've talked about this in previous episodes and understanding the investment style that you're comfortable with. And if you've got that, then it makes it easy because you've got the basic principles as to why you might be holding something for the long term. I think having a degree of single-mindedness or probably bloody-mindedness and self-belief is quite important. But I think it's very important that it doesn't come with arrogance. But that single-mindedness is important because you've got to be able to block out some of the momentum noise in markets that might be running away from you, where you think that actually you should be more of a trader. And then I think you've got to be quite analytical and have a continued thirst for knowledge. And it was the late Charlie Munger that said, I see people rise in life who are not the smartest, maybe not the most diligent, but they are learning machines. And I think that's really important. Every day you've got to be having that thirst for knowledge, wanting to read something else, and really every day is a school day.
Yeah, I like that. I think I'd add that I think to be a long-term investor, you've got to be a resilient character because you're going to be going through periods of underperformance. And I think the fundamental behind that is delayed gratification. I think if in life you've been brought up to wait for things, that's perhaps a good background to have had. Not everyone has that good fortune, but it can be as simple as things like having to learn a musical instrument. As a child, I think when I was about 6, I started learning the piano. I used to have to practice every day before school, and I did all the grades up to, I don't remember, grade 6, I think. And just that practicing, but actually then it's later on that you get the reward in terms of reaching the next grade. The same could be true of sports, or my grandson's just joined the Cubs, so he's got to do certain things in order to get the next badge. And all that is training in delayed gratification. So I think that's quite important because you make a decision on an investment and then you just require patience.
Yeah, that's a good point, Rosemary. I mean, you wonder, maybe I'm going to sound like an old fogey now, but in these days where actually society has got used to slightly more instant gratification, it'll be interesting to see how that feeds through ultimately to what kind of investors are coming of age now, and whether these momentum markets that, especially through COVID, where private investors got excited about investing in the stock market, maybe for the first time, whether we end up with a generation of shorter term traders as opposed to long term investors.
Have each of you come across or worked with alongside many traders short term? And if so, what were the differences between somebody who thinks long term, holding companies for multiple years, and someone that trades more short term?
Completely different beasts. I guess we're the boring ones. I think I'd have a nervous breakdown if I had to trade like that. It's just completely different. I would say it's a completely different way of investing, but completely different people.
I think we see it in the nicest possible way. We see it with our dealers, and that's been true of all the dealers I've had in all the firms I've worked in. I'm not picking on a particular bunch, but their job is of the moment, of the hour, of the day, and their task is usually to get the sort of best deal they can, often, within minutes. They just have a different time horizon, totally.
Yeah, it's interesting, isn't it? Because sometimes we might be dealing with something that's relatively illiquid and it's illiquid and they'll be trying to hang on for the extra penny, whereas actually we're investing for the next 10 years or so in that extra penny, and you're really looking for liquidity and to get it in the portfolio as opposed to faffing about over a share price. So yeah, completely different beasts.
I suppose it's quite important here to clarify when we talk about the long term. You've mentioned there 10 years. Some people, a year, 2 years is long term. To some people, it's 20, 25 years. How long are we talking? Do you hold companies for? Or what's the longest that you've held a company for?
I've certainly held in my private investments decades, many decades, and a couple of names. One of them I know that Rosemary's a fan of as well is Games Workshop, that's in Rosemary's portfolio. And then you've got other companies like James Halstead and some other good quality names that I've held in my own portfolio for decades, which has really rewarded me through that time. And then professionally, probably about 20, 23 years, I would have thought, maybe max. But yeah, the FCA tries to put you in buckets when it comes to your investment horizon, and they would regard long term as being 3 to 5 years, I think. We're a bit longer than that.
Yes, the difficulty here is that if you think about any business making decisions, whether it's hiring people, taking on new office space when people had offices, or putting capital into a new factory, a new production line, or making an acquisition, any sort of deployment of capital, the time taken for that to bear fruit is usually several years. So it's rather unreasonable of investors to expect companies to deliver on things over a year or two. And yet a lot of people do behave that way without really thinking it through. As Judith says, we would probably consider 5 years or 7 years or more as more likely a long-term horizon. And for me, yes, as with Judith, my private investing horizon is decades, largely because it's a buy and hold situation, because otherwise you'd get conflicts of interest with the day job. So you buy things and you just sit there with them. And that's quite a good discipline, actually. And in the funds, if you take it over my various employments, I think the longest one that I can identify is Games Workshop, because I've owned it since IPO, initial public offering, which was in 1994. It's interesting, isn't it? Because people get quite exercised about expansions of PE multiples, and then you'll see a PE multiple perhaps expand and think, oh, let's sell that and go and find something cheap again. But if you look at Games Workshop over the 29 years that they've been listed, I think I'm right in saying that the PE on which they listed historic was about 12. So they had after-tax profits of about 3 million, and the market cap was 35 million. And you've now got a £3 billion company. And the PE multiple may have, say, trebled, but actually they've issued virtually no shares over that period. We're talking an 80 bagger, something like that. So a trebling of the multiple wasn't really the big event, was it? It was just continuing to invest regularly and to keep developing the intellectual property. So I think it's an interesting lesson in what the benefits of sticking in for the long term and ignoring the noise.
I know it's a broad and a difficult question for you to answer, but how do you ignore the noise? There's more of it today than perhaps maybe 10, 20 years ago. So how do you ignore the noise?
I actually think it's a good question and quite a fundamental question as well, isn't it? Because if you look at all the different inputs to that noise, then you'd be running around like a headless chicken, wouldn't you? So you'd be changing your investment style every 5 seconds. I think it just goes back to fundamentals. Part of our job, I think, part psychologist and part analyst, really, isn't it? And the psychologist bit is about hopefully keeping you true to your investment style. Also, trying to understand management teams sometimes as well. And then you marry that with the analytical nature of our jobs. For me, looking and understanding the fundamentals of companies, looking at how that might pan out over the longer term and the earnings progression and your confidence in the earnings progression, which should then then lead to multiple expansion as well, then actually, if you keep it simple like that, then it's quite easy not to have to get distracted by the background noise. And of course, there's always something. There's always a great new thing in the background that you've got to take into consideration when it comes to those underlying earnings. But actually, even in year 2000, when planes were supposed to be falling out of the sky, these new things are never quite as shiny and as great as people sometimes expect that they might have been at the outset.
Yeah, I'd agree with Judith that you're focusing on the fundamentals of the business that you're investing in, recognizing that you're owning a piece of a business rather than some sort of poker chips. So focusing on the business and how it's developing, there'll be certain things which aren't noise, but which one should regularly evaluate. So the management, is it changing? What does that mean for the strategy? Or another key thing would be acquisitions and making sure if companies are making acquisitions that you're really clear about whether they make sense and are looking at them and paying the right price. There are certain things that are more fundamental than whether interest rates are going to be 3% or 4% in the next 12 months.
Yeah, it's interesting. And you've been through the tech bubble, you've been through the financial crisis, and obviously COVID. I mean, there's three pretty serious, significant recessions that all had their own potential ending of the world sort of scenarios, particularly COVID in the early stages when we weren't really too sure. But how did you hold your nerve through those recessions and all that brought, and probably seeing significant drawdowns in your positions?
In a way, part of the answer is what you've already said, which is that these things do happen regularly. They always look different each time. They're never quite the same. People who invest need to understand that these things are going to happen. So you should go in expecting it. So the first thing is they're not to panic, absolutely not to panic. I think one important thing to remember is that if you've got a listed business, unless they're really turned out to be made of straw, can and do raise money from investors when times get tough. So it is relatively rare for listed businesses to go bust. Some do, but I say they're pretty flaky from the outset. But the vast majority are halfway decent. If times get tough and they need to raise some capital, they can do so. And actually, if they need to raise it very quickly, they can do a limited placing and get the money in within very short space of time. So that is hugely helpful, compared with private business or even possibly private equity business that's heavily leveraged, maybe. So I think there's that reassurance. You can reduce the stress by mainly investing in businesses that have little or no debt, because there's nothing like debt to destroy the value of equity when times get hard. If you are nervous or risk averse, one way to invest in equities without completely causing yourself anxiety is to pick companies that have got cash. And then the other thing possibly is also to pick companies that we would term quality. They'd have decent profit margins, perhaps long-standing management, not making too many acquisitions maybe. There are things that you can de-risk it with.
Yeah, that's very true, Rosemary. I think it's worth pointing out, though, that as an investor, you're not going to avoid those moments of stress and angst and drawdown. It is part of the job. And I have seen some investors ending up sort of leaving investment because they didn't like it. They didn't like that part of it. So it maybe goes part back to Rosemary's point at the very start about resilience and being able to stomach those slightly harder times, but using all the tools in the toolbox to be able to avoid, the big, horrible mistakes and disasters that might ensue through a cycle. And if you're nervous about a cycle coming on, then being a little bit more defensive in your stock selection. But I think both Rosemary and I are great advocates of not overgearing a balance sheet. So I think we all know that's really what kills companies going through these types of cycles. And you need to really have lived through one first before you can start wearing the scars, I think, of understanding how you might react to a drawdown that's quite significant. For me, it's about, as well, we've got a real privilege of being able to be quite close to our underlying investment. So there's nothing like knowing that you're in the trench together and being able to phone up management teams, asking how they're reacting to whether it be a different interest rate environment, inflation, supply chain issues, is really quite reassuring. And it gives you the confidence that actually they are capable of working through difficult markets where sometimes companies might not have those levers to pull. So for me, that's an added layer on top of what Rosemary's already said, where you can actually protect yourself to a certain extent through knowledge.
So the tech bubble was your first kind of big event, your first big serious recession. Like you mentioned there's always that first experience, that first being baptized by fire, should we say. Have you got any stories from that somebody who's newer to investing, maybe just listening to this podcast now, hasn't experienced 2007 financial crisis, perhaps maybe even only just started after COVID. What was it like in that first experience for you? Have you got any stories from that time?
Because I remember.
So-
Yeah, I suppose I had quite an interesting time. I've lived through 4 cycles, but the one that was probably my first one as an investor was the tech bubble of the late 90s and early 2000s. It was interesting, I suppose, because I saw both sides of the fence. I started off as a technology analyst, actually. Imagine it. It's a bit like shooting fish in a barrel at that point. You could basically choose any stock and it would go up. That was quite interesting. What I didn't like about being on that side of the fence when the markets were going so crazy is that, as we know, brokers are always optimists. They have to be, really, to get the market continuing to move. And I was the analyst that was writing the research on companies that were coming to IPO. And what was particularly difficult was that these were early stage technology companies, sometimes coming out of universities, that were being valued on pretty heady multiples. And I remember one in particular, and I think it was probably the defining moment where I decided that I was going to jump the ship to move to the buy side. I was out on the road with this company. It was a company that we're raising 45 million for on a 40 million pound valuation. I had some minimal revenues, probably proof of concept stage more than anything else. And they were keen to put a forecast out into the market that showed them going from break even to 4 or 5 million of profit, not even revenue, in a couple of years of trading. I'm not saying it wasn't believable, but it certainly took a little bit of confidence to think that they could even get there. And I was the analyst that was penning this research, and I found it quite uncomfortable. But in those days, the analyst would also go out on the road with the company. And I remember going out on that roadshow that was supposed to last 7 or 8 days. When we got to lunchtime on the first day, the book had already been filled. So that 40 million had already been raised through 2 or 3 meetings, maybe 3 or 4 meetings. And so therefore, it was such a momentum market. Everybody had the fear of missing out, was jumping on that bandwagon because everybody was so keen to invest in this, which was really a concept, not really a company. It meant that the fundraising was oversubscribed. And so instead of being done at a valuation of 40 million, ended up being another 25% ahead of that. So in other words, this was a really expensive company with a lot of risk that was going onto the market and having raised quite a lot of money from institutions. So that to me was very uncomfortable. So just at the tail, or I suppose the middle actually, of the com bubble, I got the opportunity to join Aberdeen Asset, and I then moved into investing in both private and public companies. And seeing it from the other side of the fence was quite interesting. I saw how our private equity side, venture capital side, was using this momentum market to take companies to market, to IPO, initial public offering, and effectively using it as a bit of a dumping ground after many years of not getting exits. And it's one of the reasons that I steer clear of any IPO that has a private equity house behind it, but also why I probably steer clear of IPOs as well. There's actually quite a lot of similarities between that tail end of the dot-com bubble and where we are now. So private equity has seen the lowest level of IPO exits for the last 10 years, the last sort of 8 months or so. However, their valuations, their EV to sales, price earnings ratios, etc., are about 3.1 times, which is 25% higher than the SP 500 index and a good bit higher than the UK market. So in other words, private equity tech deals are priced wrong. And at the moment, there's no exit for them. And that's another bubble of sorts that I think will end up playing out. There's nothing new really in the world. And I see that kind of happening again to a certain extent. And it could well be that when the market does pick up for UK tech companies, that you end up getting a plethora of private equity-backed companies coming onto the market at the wrong valuations, a bit like you did through COVID as well. So yeah, that was my experience through the first bumpy ride, I think. Certainly wore quite a lot of scars from that.
Very interesting to hear that you saw it from both sides of the fence. That's fascinating. One of my recollections from the tech boom was how thin the market got towards the top. At the time I was at Schroders, and we had a holding in a company called Durlacher, which had been a sort of market maker turned tech concept stock. We decided in very late 1999 that we needed to get out, that it was ridiculously overvalued. And I remember that we had to trade about 90 times or something in small amounts in order to exit the position in the next few weeks, because the only buyers in the last 10 weeks before the tech boom finished were small investors. And so it just took incredible amount of patience and effort to exit. There were no institutional sized buyers. So I think it is worth people trying to sort of look at the depth and perhaps volumes in the market if they're investing in things that have gone a long way up. You don't want to be the tail end Charlie. Moving on to the sort of financial crisis of 07, 08, I think one of the most sobering things for me was actually a memory about the sort of physical world rather than a market, which was walking down Moorgate in the city and seeing people queuing at the branch of Northern Rock wanting to get in and take out their money. Northern Rock, as I recall, didn't have very many branches around the UK, so it wasn't something you would have seen on every high street. But it is a sort of thing that you remember all your life, really, I think, to see a run on the bank in that sense, people actually queuing. I think that was very shocking. The other thing I do recall is actually afterwards, because the authorities, of course, moved with the threat of a financial meltdown. They moved aggressively to reduce interest rates. And what happened immediately after that was that you had 6 months of what came to be known as a dash for trash, where every company that everyone feared was about to go bust and had lots of debt suddenly wasn't going to go bust because it was hardly paying any interest. These sort of highly indebted, weak businesses surged, and for 6 months one felt, as a sort of an investor focused on quality, that one was completely stupid. It didn't last. It was just 2 quarters of pay, and then these sort of businesses that were struggling continued to struggle.
That's so interesting because we mentioned earlier about how do you ignore the noise or the distractions, the latest hot trends. Most people are going to think of hot trends, crypto, AI sort of trend at the moment. But there, back in 2008, that was another trend, wasn't it? That was very heavily indebted companies that were benefiting from the low interest rates. And that was a trend that you were stood there watching going, am I missing something here? But you stuck to your values, you stuck to your principles. And after a couple of quarters, you're proven right. And one of the things I'm getting here is that your ability, if I'm a paraphrase here, your ability to hold through these types of recessions. And I'm sure there must be moments where you felt a little bit nervy, but you still were confident in the companies that you owned because you've done the work, you've done the due diligence, you trust the leadership, the management to navigate the business through that. James Halstead, Judith, were they founded in the 1950s? Was it the 50s they were founded?
I think so. Maybe before that, actually.
Maybe earlier. Yeah, it might be the 40s even.
Yeah.
And it's family run as well, isn't it? So they've got...
It is, yeah.
They've been through various recessions over the time and seen many cycles. And here they are still today, a very successful UK company. So that's interesting as well, isn't it?
Yeah.
That we think of the latest hot topic, the hot trend, but there's a company in the UK producing flooring that's been going for 70 years plus.
Yeah, exactly. It doesn't need to be new and
Incredible.
shiny to be good. Yeah, a flooring company. And how boring is that? But really well run, as you say, kind of family owned, or a good percentage of the equity held by family still. And they've moved with the times. There's been quite a lot of technology, believe it or not, in flooring that they've managed to jump on as well. And as we all know, flooring goes through fashions too. And they don't just serve the consumer, they're doing anything from industrial as well. So they really expanded their offering. Just on that point, how do you hold your nerve? Rosemary touched on it there as well. Each one feels slightly different, but they're all the same. And when it comes to our big drawdown, and you've got to think about the cycle of investors' emotions. And you want to be buying when everybody else is panicking, which is a really difficult thing to do sometimes. But Russell Investments put out something called the Cycle of Investor Emotions, and it's got 4 stages. And I think everybody can probably relate to them in some way. So you get that kind of first stage of the bull market, you get optimism, excitement, the absolute thrill, euphoria. And that's when people are actually buying the stocks off the market. And probably people like Rosemary and I are sitting back going, what on earth is going on? Why is something gone from 15 times to 40 times earnings in the space of 8 or 9 months when the earnings have just continued to do the same? And then, of course, the things come off the top, that bubble bursts, and you get more of a recessionary market. And sometimes you don't know what's going to cause it either. We had no idea that COVID was going to come around the corner. We knew that there was probably going to be a black swan event of some sort, but then you get that denial, fear, anxiety. And, you get the initial drawdowns that are anything between 20 and 30%. And then people just start selling into absolute panic, bit of depression in there as well, capitulation and despondency. And then you go through that next stage where a recession always takes a bit of time to wash through, and you're beginning to get a little bit sort of skepticism. Then that's followed by a little bit of hope and then relief. And then you go back on that bandwagon again where you're getting optimism popping back in. And we saw that a little bit towards the tail end of last year, actually. where everybody thought interest rates are coming down, inflation's fine, don't worry about it. And the market was doing a look through on what might be the case over the course of the next 12 months. But that euphoria can be quite short lived. That's why you don't really want to be a momentum player, because you're just going to be trying to ride that cycle and that bouncy cycle all the way through. But it's worth looking at. Russell Investments have done a fantastic graph going back, I think, to 1971 it must be, where it shows that kind of euphoria, depression bubble all the way through. And you can see how that behaviour has influenced the markets. Quite interesting.
I'll see if I can find the link online for that, and I'll share it in the show notes below. Rosemary, you've got an interesting story around COVID, haven't you? Because you weren't just investing through COVID, you actually were launching a fund through COVID.
Yeah, so that's an unforgettable experience. At Downing, we were getting ready to launch the Unique Opportunities Fund in January 2020, and we put the sort of prospectus into the regulator for comments, and with it a model portfolio, a view of what we were likely to own, so they could see that what we were likely to own fitted what we said we were going to do and all those good things. And so that these things take a few weeks, and we got a sort of ducks in a row and launched in the middle of March. Sometime in February, the market in which I'm investing fell by something like 25-30%. And it was still falling on the day that the fund got its first money to invest. And of course, as you've said, Lee, you didn't really know. We hadn't really got a grip on what this virus was going to do, how we were going to treat it. It was scary times, but at the same time, it did look as though this was going to be an opportunity to invest in some really good businesses, 30% cheaper than had previously been possible. And so we pressed ahead. I suppose I sat back and thought, how am I going to rationally try and do this? And so I started with my sort of model list, looking down and thinking which of the companies in the list have got enough cash that they could actually pay a whole year of their corporate expenses to exist as a business and not need to take on any debt, which is a reasonably extreme position. But there were quite a few companies in the fund, going into the fund, for whom that was the case. And then having put those in, I then thought the next stage, what about the companies that might have to go into some debt to survive a year, but they've got the facilities in place, right? So they can do that. So then we crept into ever so slightly more risky set of businesses. And then slowly, as things became a bit clearer that there was going to be vaccines, and it started to become more obvious that there were groups that were more at risk, but there were the groups that were less at risk, and you just started to get more of a picture. Then we progressed with putting in the rest of the companies. But I think it took 3 months to get to sort of 90% invested. I definitely took my time. It was interesting. Only 2 of the 30 or so companies that went into the fund actually needed to come to the market and raise money. And in both cases, they only raised 5% placing, which is a lot. Indeed, one of them, I think, didn't really need to do it. They were just being super cautious.
It's interesting that you essentially doubled down on your strategy. You extended the time frame of how long can this company survive if they're not bringing in any revenue, which was 12 months. Yeah, it's a good lesson.
It's a stress test mentality.
Yeah, and I think that's something that we've never really had to do in the past. You're going through recessions, you never said, okay, 100% of your revenue is just going to disappear pretty much overnight. You've got to, I think, react quite quickly in these situations to decide what the priorities are going to be. And I just certainly remember, Rosemary, you probably don't quite remember, you maybe do remember the date, but it was the day after that you launched the fund you launched the fund the day after Boris Johnson told us all to go home. It didn't officially announce lockdowns at that point, but it's the morning after. I do remember taking a deep breath at that point to press the button, not quite knowing what was lying ahead of us at that point. But it was an interesting time. I think another sort of reasonable thing to do in these types of situations, because typically you know the companies quite well, and you know the management teams, you know actually probably how they behaved and coped through previous recessions. What you don't know is how the market's going to react. You don't know if the market's going to fall another 5, 10, 15, whatever it is percent after it's fallen, say 20 odd percent. So what I find quite cathartic is actually just knowing that you understand the companies, how they're going to react over potentially the next 6, 12 months or whatever it is, and just buying a little bit more in bad days in the market. So just dipping your toe in. You don't need to say, right, okay, there's another 2, 3, 4% to this position. But actually just seeing a share price taking a horrible tumble and on no fundamentals, just because the market's been difficult, going in and actually picking out stock on days like that, you can make some really good returns out of it. And you don't need to be absolutely piling in and spending all of your cash. You're just chipping away at it.
Yeah, important sort of lesson, that, isn't it? You don't have to go all in, do you? On the flip side of that, you've held a company for a long time. You've watched it rise in value. You've seen the percentage in your account increase. How do you hold on?
Well, I would actually slightly counter by saying if you're running an open-ended fund in the UK, which I am, there are rules about what percentage of the fund you can put in any individual company, known as the 5-10-40 rule. So no one company more than 10% of the fund. The top five mustn't add up to more than 40%. So you're constrained by that. In my earlier example about Games Workshop, if I'd had a single open-ended fund and hadn't had money in or money out over the years, you'd be forced to sell shares in Games Workshop to stay below 10% of the fund quite a lot, actually, in the time horizon. We are rightly constrained by those rules so that we don't end up betting the ranch and putting investors through too much individual stock risk. So there are occasions when you do realise some profits to have a portfolio that's constructed in a sensibly balanced way. I think it's worth just emphasising that's important. And actually, you don't really want to get to the stage, I would suggest, where an individual company in an open-ended fund is accounting for, say, 9% of the fund, because if it continues to do well, you'll be forced to sell shares, and it may be at a time not of your choosing. That's just an observation.
Yeah. Portfolio management really, isn't it? It's probably slightly different. If you're running your own portfolios, or a portfolio, should I say, you might be prepared to take that risk of having a much larger position. But I think it's also quite a good discipline, isn't it? Just to be trimming something back and taking profits as you go, recycling capital. And that's the sort of discipline that open-ended funds really make sure that we're doing for retail or all investors.
The counter argument, as Judith says, if you're a private investor, you don't have those constraints. You can run winners. And I think it's true for most people that most of their money will end up being made by relatively few. That's been my experience as a private investor, I must say. There are sort of many worthy contributors, but often a handful of absolute standouts. There's clearly no right answer to this question. But as I've said before, you need to make sure you're comfortable with the fundamentals, be it who's running it, whether they're still sticking to the knitting, or risking your investment by taking on too much debt or making too many or too expensive or too risky acquisitions. Those are the sort of fundamentals you just need to keep watching.
So many great lessons, so many great insights. And for me, taking away, confidence you have in the companies that you invest in is what gives you the confidence to hold through these recessions, through these difficult times. These businesses, you've looked at the details, what they do, how they make profit, the products, the management. You understand them and you trust them to keep going for many years, decades, in fact, as James Halstead. And it's worth noting as well, you've mentioned you take profits as they rise in value, sometimes due to the FCA rules, which, as we said, quite right. So as we come to the end of the podcast, it's going to finish off on a book to share. But before we get there, one thing that we haven't discussed in this series is portfolio construction or portfolio management. And I just think that'd be a great episode if you would be open to adding one more episode in this series on portfolio construction. Would you be open to that?
Yeah, I think that's a good idea. Yeah, only when we were coming on to talk about trimming and the 540 and everything else. And people got different ideas on this as well, on what minimum positions and cash levels and everything else. So yeah, I think that's a good idea. I think there's probably an episode on that.
Yeah, there is definitely an episode. I think that'd be another really interesting episode for the audience. So yeah, let's finish off then. One book to read from each of you. So that'd be absolutely excellent.
My suggestion for a book this time round is a tribute to one of the world's greatest investors who recently passed away, and that's Charlie Munger, the long-time business partner of Warren Buffett. And Munger, a long time ago, wrote a book called Poor Charlie's Almanac, which I think has gone out of print, and getting hold of a copy was difficult and expensive. But I think quite coincidentally, he'd been working on a reprint with a publishing house in California called Stripe Press. They have republished it in the States, and it's about to be available in the UK. So my recommendation is, when it's available, Poor Charlie's Almanac. So I should explain, it's not strictly just an investment book. It's actually a collection of, I think it's 11 episodes, which are speeches that Charlie Munger gave. And the final chapter, it basically is fascinating because it's going through a lot of his mental models, which he used in investing, but are also relevant for life in general. The first mental model that he talks about is all connected with the subject of incentives. If you think about it, incentives are very relevant in investing. It's important to know whether a management team have a lot of skin in the game and therefore care a lot about the share price, or whether they don't actually have many shares and just going to get a lot of options if they boost earnings. Things like that are really relevant, but it's relevant in life if you're dealing with any sort of supplier, how are the incentives arranged so that you get what you want and they get what they want. It's just absolute testament to the man that he thought deeply about these things, and I think should be a valuable book for people to read.
When it came to L-tips, he talked about if you put sugar on the ground, you're going to get mice or something along those lines. It goes back to that instant gratification point. Yeah, the sugar rush that you might get on something that's very sweet, but doesn't actually pay off in the long term. Since Rosemary's pinched my book, I've resorted to some podcasts that are probably about my staple diet to a certain extent, but probably quite more so this year as we're going into an election year, just trying to get as up to speed as you ever can do with politics and what's going on in the world. And I like to digest these things in bite-sized pieces. So 2 podcasts that I tend to listen to very regularly are The Rest is Politics, which is Alistair Campbell, former director of communications at Downing Street. Probably remember him from before, and Rory Stewart, who was a cabinet minister. So coming from 2 different sides, political sides, and they're pretty good at bridging that kind of political divide and making it quite real and cutting to the chase when it comes to some of the political debates that tend to go on a daily basis. It's a real kind of insider's view on politics. It's actually quite good fun because they do take the mickey out of each other quite a lot as well. So it makes it relatively entertaining. And the other one that's a daily podcast is The News Agents. And that really is just a review by 3 very good, or I think good journalists. Emily Maitlis, she was the Newsnight anchor for a while. John Sopel, he was the political correspondent of the BBC, and Lewis Goodall, and I think he was the political correspondent for Sky. And I like it because it just makes some of the more complex issues of the day quite simple, and again brings it to life and allows you to put your own view on things without having to go through too much pain on reading every single line of a newspaper and a political edit. Yeah, those are my 2 alongside Mr. Munger, the late Mr. Munger.
The Rest is Politics is a good podcast show, isn't it? It's, as you say, it's entertaining while also being informative. Great shares. Yeah. Brilliant episode again. Really enjoyed it. Next episode, we're going to discuss some of Rosemary's and Judith's best investments, which we've perhaps maybe shared a little bit on here. But we're going to also discuss some of your worst as well, which is it's the side that investors don't tend to talk about as much, but perhaps maybe they're the greatest learnings as well. So I'm looking forward to really digging deep into them. I don't know about you two.
Yeah, that'll be cathartic. Thank you for that. Yeah.
I think, for the audience to hear the ones that didn't work out, they can be as big a learning as the ones that do work out. So I'm looking forward to that one. And also the additional episodes. So we've now gone from a 6-part series to a 7. We're going to be adding portfolio construction in there. So
that was definitely done, Lee.
I know, it was very well negotiated, wasn't it? I didn't even see that happen.
Online, what it was...
Online, there's no backing out now. The whole world's heard it.
Perfect.
Well, that's it for today. Now, next episode, Judith and Rosemary will share some of their best investments, as well as some of their investments that didn't work out as expected. But perhaps more importantly, what they learned from those experiences. It will be another insightful episode that reveals how 2 seasoned fund managers think and how they view investing for the long term. To learn more about Rosemary and Judith and Downing, please visit www.downingfundmanagers.co.uk. All the links are just below in the show notes. And if you liked what you heard, please subscribe and leave us a comment. The more feedback we get, the more value we can offer. Thanks for listening. I hope you have a great day, and bye for now.